Yash, today we're talking about pension consolidation. Now, the typical kind of person that needs to pay attention to this is somebody who's had a maybe 20, 30, 40-year career. So maybe they're 50 to 60 years old. And over that time, they've accrued multiple individual pensions. And so one of the most responsible things they can do is consider pension consolidation. So starting from the ground floor, what is pension consolidation and what are some of the advantages?
I think keep things simple. That's what I always believe in. So if you're looking at pension consolidation, that means if you got one or two pensions, which you might have had from previous jobs and things like that, pension consolidation gives very simplified way that you got one pot that you need to look after. When you have got one or two pensions, you always wanting to know what is your attitude to risk on that. So you could have one pot which is classed as low risk and the other pot which is classed as high risk. So, and we need to find out what your attitude, what are your objectives, why, which risk level you should be. That's important to sort of understand between the two pots. Working with that objectives, you put the investment planning together. So it could be medium risk, it could be high risk, it could be low risk. It all depends on clients' attitude. So we can help clients to work out how they can apply that risk, understand what risk means. Risk is very simple. A lot of people think if you're investing into stocks and shares, they fear that they're going to lose money. Because yes, they can make money, but they can also lose a lot of money, which is correct. But the way the investments are worked, you can actually look at saying, the investments are diversified. So whether it is a low risk or a high risk. So one company or 2, 3, 4 companies going down because one sector, so for example, in your technology sector, that suffers, but you got other markets which will pick up and balance your fund. So when we look at investment strategies, we'll always look at capacity for loss. If you're investing into an investment, how much will that fund go down by? And that is controlled by the fund managers. So you don't have to worry about that. When you key in and say, I want to be balanced risk, we look at that capacity for loss for that will be between 5 and 7%. And that has been tested over the last 5 years, because over the last 5 years, we've had the most challenging in the investment markets, because we've had the Brexit in UK, COVID. As a prime example, what happened with COVID? It is global. So when that happened, how much did the markets go down by? So that is a good test to have. And I'm pleased to say, with the investment strategies that we have got, or the ones we use, all of them have come through and now giving double-digit returns over the last 5 years. So even although in the COVID time, the fund might have lost 7, 8, 10%, right? But if you look at year by year, it's given double-digit returns, which is amazing, right? I'm not saying that that is what will happen in future, but if you look at the history, it has produced that in the most challenging times.
Talk me through the process. If yourself and a client have established that there are multiple pensions in place for that client that need to be consolidated, what are the step-by-step processes and how do you administer it on a long-term basis for that client?
If somebody comes to us, or a person comes to us and saying, right, we've got 1, 2, 3 pension pots, the process we call that is pension audit. So what happens with the pension audit? We actually write to the pensions that the clients have got, to them to say that, can you give us the information about the client's plans? So what we're looking in there is we're looking at a number of things. First of all, we're looking at saying, what is it costing them? Each plan will have different costs. So if it's an older plan, sometimes the cost is quite high. So we need to look at that. But cost is not the only thing. We look at where is the money invested and how is that money growing for them. So we compare that with the current marketplace and is it above average returns, which if it is, that's a good news. But with consolidating, you will be able to sort of manage all of that within one plan rather than 2, 3, 4 plans, right? So that could be it. But what you got to watch out as well with the pension audit is somebody's got a pension plan and you don't want to accidentally move that and consolidate that, because you could lose benefits that are secured within their pension plan. The benefits like guaranteed annuity. If they've got an amazing guaranteed annuity of say 10-12%, there is no way you should transfer that. So we will highlight that to the client. There is safeguard benefits that are protected in their pension plan. So if you're transferring that, you lose that. Now, you might still want to transfer it because the benefits you're getting from it is not important to you. So we need to work out with the clients is what is important to them. Or it could be that the plan they've got and the investment strategy they're in is providing the benefit they're looking for. So if the investment strategy is really good and the cost is good, or even the cost is high, it still might be better for them to stay where they are. So it's important to understand you either stay or you consolidate.
Once you've consolidated somebody's pension, how do you administer it in the long term? Because you've taken these existing legacy pension pots and you've put them either into one or two new pots, but you've also changed the dynamic and the chemistry of these pensions from a cost and return point of view. Do you actively manage it, and how do you then charge for that?
Once the client is onboarded with us as a client, we have the ongoing servicing commitment that we give to the client, which is to make sure that their funds are providing the performance that we were looking for, what our objective is. And we review all the funds every month. So the clients will at least have one annual meeting, depending on what level of service they're looking for. We got clients who we will look at and review their investment strategy every quarter. And we got clients every year. Right? So this will be a difference in charges as to what they pay us. So the person who's getting every quarter review will be able to switch the funds every quarterly if it's required. I'm not saying we need to change it, but we look at saying what the strategy they're in. So we look at what the average market is and is the performance above average.
Perfect. And how do you charge for that? So you have you just take a slice of the upside from the pension? Because obviously when you're actively managing it, the idea is that you're going to outperform these kind of like static passive pensions.
The charging structure is that when you consolidate, there is one-off fee that the clients would pay. We will agree that fee with the clients before we engage to that work. And once the consolidated work is done and they're in our hands to manage, and we charge a % of whatever the fund value is.